Happy Friday, everyone. Thanks for joining us today on this edition of Business Daily. I'm Lee Ji-yoon in Seoul. Before we get started, let's first get a glimpse of today's highlights. The National Assembly passes a bill to impeach President Park Geun-hye today. And with that, financial authorities hold emergency meetings to discuss the impact on the local economy. A lot went on over in Europe this week, with Italians voting down a constitutional reform and the ECB extending its quantitative easing program. We have these stories and more coming right up. The National Assembly has voted in favor of President Park Geun-hye's impeachment. And in response, the president said she calmly accepts the result and asked ministers to carry on with state affairs as normally as possible. And the country's financial authorities have also held a number of emergency meetings to discuss market stabilization measures after the vote to impeach President Park Geun-hye sailed through the Assembly. To brief us on some of the details, we have Kim Min-ji on the line with us. So, Min-ji, what's the latest?
Ji-yoon, we'll start with the Finance Ministry. Finance Minister Yoo Il-do convened an emergency meeting with top officials shortly after the results were out. The officials said they will keep close tabs on the situation and draw up countermeasures. Yoo is also expected to convene an economy-related ministers' meeting to discuss the potential impact the parliament's vote could have on the real economy and markets, especially as experts say the results could impact Korea's credit rating and cause fluctuations in the Korean currency. The Bank of Korea also convened an emergency meeting of its own. It was chaired by BOK Governor Lee Ju-yeol and attended by other top officials at the central bank. They said the latest vote could cause market volatility and vowed to monitor the situation around the clock. The Financial Services Commission also met after already having drawn up a number of scenarios which could play out, especially considering Prime Minister Hwang Kyo-won will now be stepping in as acting president. The Commission will start implementing these measures starting Monday. And finally, as I wrap up, on Saturday morning, top government officials, including the Finance Minister, Trade Minister, and FSC Chairman, will convene a joint emergency meeting to discuss priorities for the Korean economy. This has been Kim Min-ji on the latest on the financial front.
And moving on to markets, there was a lot of buildup leading up to the parliamentary vote today. And to give us a wrap-up of this week's stock market action, we have our Business Daily's markets contributor, Choi Jin-seok, joining us on the phone today. Hello, Jin-seok.
Thanks for having me.
All right, so as we close the week, how are things looking on the last day of trading? I mean, all eyes were on Korea's political arena today.
Right. The Korean equity market closed with a mixed picture on the last session of the week. The Kospi fell by 0.3% to close at 2024.69, while the Kosdaq followed with a 1.6% uptick. On the Kospi market, retail investors who unloaded shares dragged down the entire index. Since the Korean market was trading ahead of the National Assembly's vote on the president's impeachment bill, overall sentiment throughout the market was quite muted, and investors were in wait-and-see mode.
So the National Assembly has passed the impeachment motion, but with that, what kind of impact do you think this will have on the Korean markets going forward?
First, financial markets always hate uncertainty, so the decision itself can be a positive catalyst. In particular, as experts and investors had already anticipated the bill would be passed, today's results can positively affect future market movement. But since it will take a lot of time for the Constitutional Court to make the final decision, you can expect to see a certain level of pressure imposed on the market for a while.
Right, and looking back on this week, despite today's mixed picture, the Korean equity market performed relatively strong. So how was the overall weekly performance?
On a weekly basis, the Kospi surged by more than 2%, while the Kosdaq was mostly flat. Both foreigners and institutional investors bought massive amounts of shares, lifting the Kospi index. Large cap stocks enjoyed a huge rally of around 3%, while small to mid-cap stocks performed strong as well. As political uncertainty related to the Italian referendum faded, and the European Central Bank, or the ECB, decided to extend the duration of its government bond purchase program, global stock markets all enjoyed a rally this week, especially the Euro Stoxx index surged by more than 5%.
So the ECB sent a mixed signal to global financial markets with its decision to extend the bond purchase program while reducing the amount of its monthly purchase. So what are the expectations for remaining central bank meetings?
What was more important was the reaction from financial markets. The equity markets in Europe rose while the value of the euro fell after the ECB's decision. So the overall picture doesn't look bad at all. Next week, the U.S. Federal Reserve is widely expected to raise interest rates at the December FOMC. With the rate hike, the Fed is likely to shift its stance to being more hawkish. The BOJ is not expected to increase liquidity injection at its meeting in the following week. So although the overall picture looks good, investors still need to brace for unexpected results and market volatility. This has been Choi Jin-seok for Business Daily.
The so-called 2M vessel sharing alliance made up of Maersk Line and Mediterranean Shipping has decided to no longer consider adding Hyundai Merchant Marine as one of its members, ending a 5-month-long discussion. Maersk Line said in an email that it's looking into, quote, other cooperation possibilities, which is considered a major blow to the troubled Korean shipping firm. Now, this comes as clients were unwilling to move their cargo onto Korean ships after the demise of Hanjin Shipping earlier this year. Experts say Hyundai's exclusion from the alliance would not only mean it's unable to fulfill one of the preconditions set out by its creditors, but that it would also greatly lose leverage in the international market. Railway workers are back on the job after a strike which lasted over 70 days. The Transport Ministry welcomed the union's decision to end the strike, saying it will work with the members to bring operations back to normal as soon as possible, starting with freight trains. The strike ended after the Korean Railway Workers Union reached an agreement with the state-run operator Korail on Wednesday. Under the agreement, worker wages will be decided according to government guidelines. The union went on strike in September against the government's plan to implement a performance-based pay system starting in January. Although the strike has ended, an injunction against the new wage system filed by the labor union is still pending. During a parliamentary hearing earlier this week, heads of some of Korea's largest business groups promised the lawmakers that they will pull out from the Federation of Korean Industries, possibly putting the nation's biggest business lobby group on the verge of breaking up. Our Lee Ju-young has more.
After 55 years of serving as the nation's largest business lobby group, the Federation of Korean Industries may be headed towards its demise, as Samsung Electronics, its biggest contributor in annual budget, has pledged to exit the scandal-ridden body.
I don't think I have the right to talk about dismantlement, but we will leave.
After Samsung announced this withdrawal, other major members like SK and LG Group, as well as Hyundai Group, said they will also pull the plug and make their exit. At this, experts say the lobby group, which holds some 600 member companies, is highly likely to be dismantled at the end of the day, with other groups likely to follow. They add the federation cannot possibly function with the country's top 4 business groups, which account for about 60% of the institute's annual membership fees, dropping out. While there have been growing calls for the organization to be dissolved, some say it should undergo a major transformation to become a think tank like the Heritage Foundation in the U.S.
I think at this point, the organization needs to change from the inside out. I hope it can serve as a research institute capable of global consulting.
All this comes as the business lobby group has been accused of forcing its members to donate nearly $70 million to 2 dubious foundations said to be controlled by President Park Geun-hye's confidant, Choi Soon-sil. The federation has not yet made any public comments regarding its fate. Lee Ju-young, Business Daily.
While demand for Korean beef or Hanwoo continues to fall, local beef imports have surged this year. Data by Korea Customs Service and the U.S. Meat Export Federation shows that Korea imported over 320,000 tons of beef in the first 10 months of this year, up nearly 30%. Now, during the period, shipments of U.S. beef rose 47.6% on year, taking up 41% of the total. Meanwhile, imports from Australia went up 15%. The surge in inbound shipments can be attributed to more people turning to cheaper options, especially after the country's first anti-graft law placed limits on pricey gifts, one of them being high-end Korean beef. And time now for a look through some of the important global business stories from the week. And for that, we're now joined by Eunice Kim in the studio. Hello, Eunice.
Hello.
All right, so the ECB moved according to market expectations, but there was one announcement that caught many by surprise.
That's right. The ECB extended their bond buying program beyond the deadline of March next year, but it also slowed the pace of the program, causing some to wonder if tapering is in the forecast. Take a look.
In its final monetary policy meeting of the year, the European Central Bank extended its bond buying program that was to expire in March to the end of 2017. The ECB president, in a press conference, told reporters 2 possible options were considered at the December policy meeting.
One foresaw the option of continuing with 80 billion euros a month for 6 months. And the other one is the one that received a very, very broad consensus by the Governing Council.
That consensus was to cut the bank's monthly purchase amount by 20 billion euros starting in April, bringing it back to 60 billion euros, the level at which ECB's quantitative easing program began nearly 2 years ago. Amid concerns the bank was running out of bonds to buy, the ECB also announced it could start buying assets yielding below its deposit rate, meaning the bank would be paying money to hold those bonds. In the new year, it will become open to debt with 1-year maturities, going below the current minimum of 2 years. Perhaps the most important case Draghi had to make is that this was not the start of an ECB tapering. Draghi insisted the bank did not see the end of the monetary stimulus for now, pointing to still weak Eurozone inflation and the risks ahead next year, including an unpredictable Trump presidency, Brexit, and Europe's own string of elections.
Just look at the election calendar for the year to come. There is a big uncertainty, much of which is political, and whether we can do something about that or not is an open question. I think what the central banks can do is to keep a steady hand, namely continue with the monetary accommodation that is necessary to achieve their objective.
So it looks like market reaction was mixed. Initially, European stocks and bonds dropped sharply, but later they reversed much of that loss.
Right. So investors didn't know what to make of Draghi's statement that this is not the ECB tapering, and in fact that option is not even on the table at this time, despite that monthly purchase amount clearly shrinking. But then they did the math and figured out that this new policy, in fact, would lead to more purchases by the ECB than less, given its longer term. Through the end of 2017, an extra 540 billion euros would be injected into the Eurozone. That is about $573 billion US dollars, and roughly equivalent to the GDPs of Greece and Portugal combined. But the decision comes at a time when a debate rages over the effectiveness of QE, as well as its fate moving forward. Countries like Germany, for example, have been pushing to end the program sooner than later, citing the devastating effect low rates has on savers.
And of course, there are the political uncertainties heading into next year. But did Draghi address the recent turbulence in Italy?
He did, and he did say that he has full confidence in the Italian government to be able to handle the current political vacuum left after Prime Minister Matteo Renzi resigned on Wednesday. This, of course, was a follow-through of a promise he'd made that he'd step aside if a referendum he pushed failed with voters, which, of course, it did. There's also the question of Italy's banks, perhaps best represented by Banca Monte dei Paschi. It's Italy's third largest bank and the oldest in the world, founded during the Renaissance. It's fighting to stay afloat and needs to find 5 billion euros to do so. The government is reportedly preparing a bailout, but the problems extend to other Italian banks. Consider this: 18% of total loans held by Italian banks are non-performing loans, and the banking system has less than half of the money it would need to cover those bad debts. This has led to some real concerns of an impending banking crisis, but Draghi on Thursday said those concerns should be kept in perspective, that these vulnerabilities have been around for a long time. He did concede, though, that it's impossible to determine now how these political factors, these uncertainties, would impact the market in the medium to long term.
All right, I guess now all eyes are on the FOMC meeting coming up next week.
That's right.
Thank you so much for coming in today.
You bet.
And that wraps it up for today and this week. Thanks so much for watching. We'll be back next week with more business news that matters to you. Until then, goodbye.